They're going to cut straight back down to zero, just like they did in 2020, just like they basically did in 2008. 2008 took a little bit longer, maybe. I don't know how many months exactly, but it was basically down to zero. This time it's going to be one cut to zero. And it's probably not even going to be at a scheduled FOMC press release conference decision board, whatever. It's not going to be that. It's going to be in the middle of the night in an emergency meeting because of something that happened, and it's going to be sudden, and then the market's going to wake up the next day and understand that the Fed did this because of an emergency, and the stock prices are going to go all kinds of crazy, and gold's going to go even crazier, and silver crazier still.
2008's great financial crisis was a perfect example of the rate cut. The Federal Reserve cut the funds rate from 4.75% in late 2007 to 0% by 2009, leaving rates near zero for the next 6 years. However, gold prices rallied almost 50% during the period. Gold prices held steady on Tuesday to hover near record highs scaled in the previous session, as markets anticipate the beginning of a U.S. easing cycle, with expectations that it might start with an outsized rate cut. Renowned financial journalist Rafi Farber underscores that when this crisis hits, the Federal Reserve will make an emergency rate cut to zero, likely during an unscheduled meeting. He anticipates this will trigger chaos in stock markets, with gold and silver prices surging dramatically in response. Various experts, including Rafi Farber, believe that the dollar's decline is inevitable and expresses relief at its fall. He mentions that despite increased money entering the system, gold is hitting new highs, which he finds unusual, as it typically peaks after inflation. The gold price tracks money supply growth. For that reason, the last 50 years have seen exponential returns in gold. Fortunately for gold investors, these parabolic money supply increases are far from over. Reflecting on past markets, Farber recalls the 2011 bull market and the painful bear market that followed in 2015. In contrast, he notes that gold's 2022 dip was mild, quickly rebounding without panic. He foresees the next inflationary wave pushing gold much higher, fueling a stronger rally in precious metals. The metal has historically delivered attractive long-term returns, appreciating 8% annually over the past 20 years. Its price has exhibited significant volatility, tumbling around 40% from 2011 to 2015 before fully recovering in 2020. Now, we present the clips of Rafi Farber's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
Look, what's going to happen is there's going to be an accident, and it's going to be serious. It's going to be like the apocalypse 5 years ago, or it's going to be something similar but slightly different. Whatever it's going to be, it's going to be. But it's a mathematical certainty because all of these institutions need trillions of dollars, and the amount of dollars that are available keep shrinking. So eventually you hit a wall, and that wall causes a domino effect. So when that happens, whenever it does, probably after a reverse, sometime shortly after reverse repos fall to zero, then you're going to see a cut back down to zero in short-term rates. They're going to cut straight back down to zero, just like they did in 2020, just like they basically did in 2008. 2008 took a little bit longer, maybe. I don't know how many months exactly, but it was basically down to zero. This time it's going to be one cut to zero. And it's probably not even going to be at a scheduled FOMC press release conference decision board, whatever. It's not going to be that. It's going to be in the middle of the night in an emergency meeting because of something that happened, and it's going to be sudden, and then the market's going to wake up the next day and understand that the Fed did this because of an emergency, and stock prices are going to go all kinds of crazy, and gold's going to go even crazier, and silver crazier still. It means the dollar is dying, thank God. With all the damage that dollar spenders, the main dollar spenders, of course, the federal government, with all the money that they're spending all over the place destroying things. There's a lot of collateral damage to the death of the dollar, and we're part of it because we spend them and we use them. But, we can adapt. We can adapt, and the U.S. government can't because that's their main resource supply, is the fact that the world accepts U.S. dollars. But as for the gold market itself, it's pretty surprising that gold continues higher here, even though, and this is going to sound a little bit maybe heterodox or contradictory, but it's how things actually are supposed to work. even though more money keeps entering the system and the money supply is still much higher than it would otherwise be had the 2020 and 2021 printing not happened, which means that the stimulus effect should still be here. Even though we're at that stage, gold is still going up to new all-time record highs. I mean, it shouldn't be that way. The gold should really only be at all-time record highs immediately after an inflationary spurt, right? Not in the months and years afterwards when the stocks start going up and other derivatives start going up, so money starts leaving gold, leaving the safe haven, chasing the momentum. But we're not seeing that now. We're seeing the momentum starting to die off and gold hitting record highs. I mean, think about what happened in the last bull and then bear market. The bull market lasted until 2011, and there was a bear market in 2015. So you had this QE 1, 2, 3, right? And then gold hit record highs in 2011. And then we had like a 4-year bear market as money started to flow out of gold. There was less of a panic about the dollar, and then they went into these risk assets again. We had a little bit of that into 2022, but gold hit a low of like 1610 and then didn't go below that. So we're seeing sort of a repeat of we saw a little bit of a repeat of the 2011 to 2015 bear market, but it really wasn't much. It was nothing compared to what we went through. I don't know if you were actively investing in gold back then in 2011 to 2015, but I remember going through 2015 and like waking up nauseous and like realizing that my portfolio was like cut in half or even like 40% of what it once was, and I was trying to convince my wife like we were right. I'm right about this. We just have to get through it. And I got through it, thank God. But it was very difficult. This one it wasn't much. Like, okay, 2022 went down to 1610. Okay, my portfolio is not doing so well, but whatever. So it's much easier this time. And we're gonna go much higher once the next inflation round starts.
Regarding the potential for a gold short squeeze, Rafi Farber says that if open interest declines while gold prices rise, it may signal stress on bullion banks. He predicts that while this could indicate market pressure, the true crisis will manifest in everyday life, potentially driving gold prices higher. On Monday, the number of open COMEX gold futures contracts grew above 546,000, swelling by 7.8% from 1 week earlier. That took an open interest in those U.S. gold futures contracts to the largest level since late July's spike to the highest level since March 2022, the immediate aftermath of Russia launching its attempted all-out invasion of Ukraine. Moreover, Farber explains that banks like J.P. Morgan don't necessarily gamble on the price of gold by taking short positions. They engage in swaps, going short in New York and long in London to balance their positions. Let's get back to the interview.
So first, I just want to discuss for a minute the concept of a gold short squeeze. This can be construed as like a cheap subject because people say short squeeze, and then we think of like Volkswagen, or that's the short squeeze that comes to mind now. That was like in the late 90s or something. These short squeezes where we like see a sudden vertical line as shorts. Oh, we could talk about nickel, the nickel short squeeze. And then, people turn off and they say, oh, another gold bug's talking about a short squeeze, never going to happen. I understand that. I get that point because theoretically, I mean, this could be true. I mean, I don't examine banks' balance sheets from the auditor perspective, so I don't know what they're actually lying about. But for every contract that a bullion bank is short in New York, they're supposed to be long a contract in London, right? They're not supposed to gamble on it. It's not that they're placing a bet on the price of gold, and a bank like J.P. Morgan is saying, well, I think gold's going to go down the next month, so I'm going to open a short contract. That's not what they're doing. They're called swaps, meaning they swap gold from New York to London. They go short in New York and they go long in London. And then if a client, stands for delivery, they just deliver the gold or they do an exchange for physical from the position in New York to the position in London. And they're not really technically risking anything. However, so when we talk about short squeeze, why is it even worth talking about then? Because maybe they're not. We don't really know what they're doing and who really owns the gold in London. And you can come up with all these theories on who owns what, but the fact is nobody really knows. Probably not even the bank knows. So what I'm basically talking about is that the amount of contracts net that these swaps, the ones that are supposed to be short in New York and long in London, supposed to be, they're record short. They have the record amount of contracts that they're selling short. And obviously, somebody has to sell short in order for somebody else to go long, right? You can't go long off of nothing. So somebody's got to sell the contract. So they sell the contract and they provide the liquidity in the market. That's what they're supposed to do. They're short like something like 250,000 contracts, maybe a little more. That's what, like 2.25 million. What's 250 times 100? 250,000 times 100. That's 25 million ounces. Does that even exist in London? I don't think it does. So something's off here. And the fact that open interest went up last week and it went up about 40,000 contracts and the price of gold went up with it. That's normal. The price is supposed to go up with open interest. But at all-time highs, it means that the bullion banks are opening these new short contracts at the all-time highs. Now, if we're going to see a short squeeze, at least on the New York side, what we should see is falling open interest with a rising gold price. We almost never see that, which tells you that at least theoretically they are balanced. They're short New York, long London, because they're not pressured. So they wait for the price to fall and then for people to either book their profits or whatever they're doing, and then they exchange the contracts. But if we did see one time falling open interest and a rising price, and that was into the 2011 top in September 2011. For about 2 or 3 months, we saw it. Falling open interest, rising gold price. We're not seeing that yet. If we start seeing that, then we can say it's a short squeeze. I don't know if that means they're going to default in London. I'm not making like apocalyptic predictions here to say that the monetary system is going to die on a short squeeze. I don't think so, because I think it's mostly a fiction. It's going to die in the streets, in the supermarkets in the United States. That's where it's going to die. That's where gold's going to go to infinity. But this could be a sign that we're going in that direction. So watch open interest. If the open interest goes down and price goes up, then we're on a New York size short squeeze. And what that does to the bullion banks, frankly, I don't really know.
The analysts anticipate gold prices rising to $2,900 an ounce by the end of next year, driven by renewed investment demand, which had been a disappointing pillar of support in the first half of 2024. What will be the most significant factor driving gold prices in the next few years? Central bank policies, inflation, or economic uncertainty? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.